With gold having made new all-time highs this year and continuing to move up to unprecedented levels in nominal terms, everyone's wondering what's next. Are we going to see even new higher gains? Can gold climb towards $3,000, or is this it for the rally? Let's talk about the drivers and the outlook for the price with our next guest, George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. George has spent decades analyzing the gold market, and he's going to give us his outlook today. Now, if you're new to the channel, make sure to like and subscribe. George, welcome back to the show. It's been a while. It's almost a year. A lot has happened to the gold market since last year, since we were on the show together. Welcome back.
Indeed it has, David. Thanks for inviting me back again.
Let's just start with my intro question. How sustainable is this rally up to $2,400 at one point?
Yeah, look, we've come back just a little bit from that. There was obviously a little bit of profit taking when you set an all-time high. I think that's the kind of thing you expect in any market. But I'm getting the sense that we do seem to have finally established the price solidly above the $2,000 area, which had been a barrier for, 5 years or more now. We'd had various different attempts to straddle that $2,000 level, now suddenly shooting up above 2,400 and seeming pretty solid above the $2,300 area. I think that, it looks to me like we've established a new floor. This is always the way. Overhead resistance very quickly becomes downside support once you've actually breached it. And if you think about it, historically, there's an awful lot of things going on that have tended to be favorable for gold throughout the 50-some years that I've been looking at it. The macroeconomic environment, I think, is favorable. We still don't know whether the Fed is going to keep rates high enough to push us into recession, or whether they're going to be able to achieve a soft landing, or there's even some talk that maybe a no landing is the logical place to go, and that the economy is just going to keep booming. Inflation remains sticky at way too high a level for the Fed to be comfortable, and the whole geopolitical environment is increasingly threatening, especially with an ugly developing presidential election in this country. So all of those things together, I think that we have a recipe for a decent performance as far as the price is concerned. That's what history suggests to me, at any rate, David.
Yes. Before we talk about the fundamentals of gold, I want to learn more about the technicals. Do you know, or are you aware of traders putting sell limits at a certain level?
Not at this point, no. I think that what I was saying, that, that finally beating that $2,000 barrier, for the best part of 10 years now, anytime gold got up close to that $2,000 level, that was a level for the speculators to sell, not the long-term strategic asset allocators. I think they've been with us all along, and they continue to grow. But the speculative elements, hedge funds, commodity trading advisors, day traders of one kind or another, 2000 was the level to sell. I think that we've finally managed to get beyond that. I don't know what levels they're going to be looking at in future. Logically, having spent just a brief period of time above that $2,400 level, that may well become a selling point for some people, but I don't think it certainly hasn't had time to establish itself in the way that $2,000 barrier had. So I'm not aware of particular targets that anybody has. The one thing I do notice is that all of the Wall Street banks seem to be raising their targets for gold prices during the year. Whether you look at Goldman Sachs or Citibank or UBS, a whole raft of people have raised their targets for the gold price, and I find that very encouraging, I have to say.
Let's discuss the drivers of this rally now. I've heard different theories and explanations. One that is prevalent is an accumulation of gold purchases by central banks over the last year. Now, much of this data was collected in Q4 2023. So I wonder if you think that has had any impact, whether or not they're continuing to buy gold, and whether or not ultimately that is the reason for the rally.
Let me try to put it in a slightly broader context, David. Sure. Central bankers, primarily in the emerging world, have been net buyers of gold for their official reserves. This is now the 15th year that they've been doing this. So this is not something that happened a year ago, not something that happened overnight. This is a very long-term, very well-established trend with central bankers in the emerging markets, selling US dollar debt in many cases where they have too much in their official reserves, and buying gold with the proceeds where they believe that they are dangerously underweight in gold. They have less than 5% of their official reserves in gold, with more than 2/3 of their reserves in US dollar denominated debt. And a lot of central bankers in the emerging countries believe that that's a dangerous skew. It's a dangerous imbalance. And so for 15 years, they've been doing something about it. They've been doing their best to redress that balance. We haven't got an awful lot of data yet on Q1. That'll come out later this month or even early next. But the data that we do have say that suggests that one of the largest buyers has been the People's Bank of China. That has been one of the largest buyers for a good deal of the last 15 years. That they have been significant buyers in the first quarter of this year. And Singapore and a number of other countries as well have already gone public with reporting purchases. So we saw an all-time record level of net central bank purchasing in 2022. We almost matched that level in 2023. We fell about 1 or 2% shy of it. And I'm expecting a very, very solid performance from central bank purchases again in 2024. Certainly the year has started off well with the limited data that we have at this stage, David.
Before we continue with the interview, I'd like to tell you about another way to hedge against inflation. As you know, one of the hottest trades of this quarter is gold, which has been hitting new all-time highs, breaching above $2,400 an ounce and up 15% year to date. Now, gold has historically been viewed as a safety play, a hedge against volatility, geopolitical unrest, or even inflation. But gold is not the only inflation hedge out there. You can still hedge against inflation using low correlation alternative assets like fine art, for example. Tens of thousands of savvy investors have found the ultimate alternative inflation hedge with our sponsors at Masterworks. Masterworks is an award-winning art investment platform that buys blue chip paintings, securitizes them, and allows you to invest in shares. They've had 21 exits since inception, and each of them individually delivered at a profit. Not counting works still in holding, they've distributed over $55 million total back in investor proceeds. So that's why over 900,000 people have signed up so far, and why previous offerings from some legends like Banksy, Basquiat, etc. have sold out within minutes. Now, for the first time, you can use the link in the description down below or the QR code here on the screen to sign up and get your first free 5 shares when you complete your onboarding by going to masterworks.art/David Lin. And as with any investment, past performance is not indicative of future returns. Investing involves risk, so check out the important Regulation A disclosures at masterworks.com/CD. Okay, so if I understand correctly, are you suggesting that we're saying that their purchases from last year was nothing abnormal, like they didn't purchase an abnormally large amount of gold relative to the historical? Yeah.
2022, they purchased an abnormally large amount. They bought more than twice as much as they'd ever bought in a calendar year before. So that was abnormal. But we almost repeated that last year. And it looks like we're off to a good start for 2024 as well. So I think that 2022 was the abnormal year. Maybe we have a new normal. As I say, for 15 straight years now, central banks have been accounting for anywhere between 10 and 20% of total gold demand, total global gold demand. So for jewelry, for investment, for industrial purposes, everything. Net central bank buying has become a solid performer in terms of the demand side of the gold equation. I'm expecting that to continue.
Is there a reason for this interest from central banks, especially to continue? What are they preparing for?
I don't know that they're actually preparing for anything. I think what they're doing is kind of rectifying where the history left them. If you think about it, most of the emerging market countries really didn't amount to very much in economic terms during the heyday of the gold standard from 1870 to 1970. That was essentially the UK, Western European countries, and increasingly the United States that were the economic powerhouses then. So their countries were being used in settlement of international transactions and as reserve currencies. And because of the terms of the gold standard, the advanced economies of Western Europe and North America had to buy gold whenever they issued more currency. And they had to keep issuing more currency to meet the demand for it. So as a legacy of those times, central banks in the advanced economies of Western Europe and North America have on average more than 2/3 of their reserves in the form of gold if you mark everything to market, which in my view is the only way to look at anything. By contrast, emerging market central banks were not able to use their own currencies because nobody accepted them internationally. So they were not forced to buy gold in order to back their currencies. So they don't have these very large legacy reserves of gold that the Western European and North American countries have. As I said, in the emerging markets, the average allocation to gold is still less than 5%. And that's something that an increasing number of emerging market countries have become very uncomfortable with. And that's why for 15 years, they've been doing their best to try to redress that balance. They've done a lot of purchasing of gold, but they still haven't really moved the needle. China still has only around about 4% of its reserves at mark to market in gold, in spite of significant purchases. So I think that this is a trend that is very definitely set to continue, David.
Okay. You mentioned that gold purchases from central banks account for maybe 20% of demand. What's the other 80%, then 80 to 90%?
Typically, jewelry is anywhere from 40 to 50%. And that is, that took a little bit of a knock when COVID first descended on us in 2020. Gold jewelry demand around the world was very badly hurt, especially in countries in the emerging markets where they took lockdowns much more seriously than North America did, for example. Now we've seen some signs of recovery, but I don't think we're back yet at the kind of pre-COVID levels of jewelry demand. Part of this, in my view, is the relatively sluggish state of the Chinese economy right now. Xi Jinping has been promising some stimulus for the economy. He's worried about unemployment. Been promising stimulus for the economy for a long time. And I think that if I read the tea leaves of the most recent party congress correctly, then I think that we're starting to see that stimulus become reality, starting to see some impact on the Chinese economy. If we get a recovery in the Chinese economy and back to the sort of growth pattern of 6, 7, 8% a year in GDP that we've seen in recent years, then we'll get a big rebound in gold jewelry demand, and jewelry could well go up. But anyway, jewelry anywhere from 45 to 50% of the total. The industrial consumption of gold, primary for electronics, tends to hover around about 8 to 10% of the total. Not really much in the way of change there over the years that I've been looking at it. And that leaves, depending on where jewelry is and where central bankers are, that leaves anywhere from 20 to 40% for investment. And I think that we've started to see the investment side pick up a good deal in the course of this year. So I think that is likely to help to support prices and perhaps even to drive them to new highs.
Okay, we will get to your new highs in just a bit. But going back to investment demand, this is an interesting statistic. So I'm just reading a paragraph from the World Gold Council regarding gold ETFs inflows and outflows. So North America saw net outflows this year extend, especially in February. However, Asia was the only region that they've calculated that had actually captured inflows. Why the divergence between Asian investors and North American investors?
I think a lot of the retail investor segment has had some exposure to ETFs over the 20 years that GLD has been in existence, for example. But I think they also have always displayed a tendency to like bars and small bars and coins, the traditional forms of investment, bars up to 1 kilogram, and official government-issued coins. We've seen a big jump in the last couple of years in those, and I think that ETF demand has suffered in part because the retail investor has tended to move toward physical possession of gold rather than owning an allocation to gold through the means of an exchange-traded fund. Now, in the last few weeks, we've started to see inflows into GLD, the biggest gold ETF out there, the one that we launched 20 years ago with the World Gold Council. And I find that's an encouraging sign that we're starting to see a return to ETF investment as well as continued strong bar and coin investment. That's a great combination for gold historically.
So ultimately, what is the biggest driver of the price of gold in any given time period? Is it physical demand of bars and coins? Is it demand for synthetic products like ETFs? Is it buying from institutions, buying from central banks, maybe an amalgamation of all of the above? What do you think?
All of the above is definitely the answer, David. No question. You nailed that one. Look, we've seen an improvement, and there's no one answer to this all the time, right? There are times when jewelry takes the lead. There are times when investment takes the lead. I think there are times even when central bankers take the lead. I think what's happening right now is that we are seeing continued very strong demand from central banks around the world. I think that that's a very, very good level of support for gold right now and has been for the last several years. We're seeing some growth in the jewelry sector. I'm expecting more if the Chinese economy recovers as I expect it to. And as long as the higher prices don't deter too much in the way of purchases. And then significant investment demand coming back as well, both in the form of bars and coins and in ETF investment. I think that these are all good positive signs for gold. They're all good drivers for gold. And if you think about it, with the macroeconomic environment the way that it is, everybody on tenterhooks as to what is the Fed going to do and when is the Fed going to start doing it. All of that. Is the Fed going to tip us into recession, or are they going to be able to navigate that somehow? How much longer will they have to keep interest rates high, given that inflation, especially on the Fed's preferred benchmark, the core personal consumption expenditure, is still way higher than the Fed would like to see it. And the Fed still has this target of 2% on core PCE, and it's way above there according to the most recent readings. And we've had some increases in various different inflation indicators. So with all of that in mind, and then you add in the shakiness of the geopolitical background, armed conflict in Europe with the potential to turn nuclear, what seems to be a spreading conflict in the Middle East. It used to be just in the borders of Israel. Now it seems to have spread, and Iran seems to be getting involved more, not just through its proxies like Hezbollah in Lebanon and the Houthis in Yemen, but directly with attacks from Iranian soil. That's all very, very concerning. China is still making rather belligerent noises toward Taiwan, and I think China is watching very carefully the actions of the U.S. government here toward Ukraine as a bellwether for what would the U.S. likely do if China started to be more threatening toward Taiwan. So you have a very we're all on tenterhooks as far as the geopolitical situation is concerned and the macroeconomic situation. And historically, that's always been good for gold in the past.
I want to touch on geopolitics in just a bit, but just finishing off with central banks, how price sensitive are central banks? In other words, now that gold has run up to above $2,300, do you expect a decrease in purchases going forward, at least until the price settles down a little bit lower?
No, my experience of central bankers, and I've had a lot of experience with central bankers. That was my main job when I was at the World Gold Council for 15 years. My experience of central bankers is that they are simply not sensitive to the price at all. They have no problem with the price going up as they're buying, because it makes them look very smart when they have to report to their masters in government. I don't think of them as price sensitive. If you think about it, for 15 years they've been buying on significant quantities, and the gold price was an awful lot lower when they started than it is now. So they're all looking very, very smart indeed by having increased the gold content of their official reserves. And I think that they expect to continue to do so. I've never known a time when a high gold price, whether you talk about the 1970s or 80s or even today, I've never known a time when a high gold price acted as any kind of a deterrent to buying by central banks. I think price insensitive would be the way that I would characterize most of their activities.
Well, given that most central banks around the world, especially in the East, have been buying, like you said, I have to point out some exceptions in the past. Canada, as you know, the only G7 country that doesn't hold any gold currently. They sold off most of or all of their gold reserves in the 2000s. Have you seen any signs of other countries in the developed world sharing similar attitudes as Canada and perhaps alleviating or selling some of their gold reserves in the future?
No, I think Canada is very much out on its own as far as this is concerned. But you
Okay.
have to remember when Canada started to sell, which was in the early 1980s, if memory serves me correctly,
Yeah.
um, they made the point that all of the foreign currency in Canada's reserves at that time in the early 1980s was borrowed. The only asset that Canada owned was gold. So you could say that 100% of their official reserves were in the form of gold. And even someone like me, who's very fond of gold and likes to invest in gold and really sees the benefits of individuals and institutions, and especially central banks, all owning gold, even I would say that 100% was perhaps a little bit overweight as far as gold was concerned. So I wasn't surprised to see them selling pretty consistently through the 80s and then through the 90s. I have been somewhat surprised to see that Canada, alone among any country that I can think of, has actually gone down to zero in their official reserves. It seems to me to be a uniquely Canadian approach to reserve management, and one that I'm not really sure that that was the right thing for them to do. I understood why they wanted to sell when gold was the only asset that they owned, but that's no longer the case. And I still, I still wonder if we might actually see Canada on the buy side again at some point in the future.
Okay. Going back to geopolitics, you mentioned a number of hotspots around the world. I remember when the Russia-Ukraine war first broke out in February 2022, analysts at the time were calling for a $200 gold premium. And as you remember, gold actually did go up significantly
Mhm.
shortly after the invasion before coming back down. How much of a war premium or a geopolitical risk premium is currently baked into the price today, George?
That's a very, very hard one to answer, David. It's a good question, but it's a very hard one. I think it varies from investor to investor. I think that the war premium essentially is really all about investment demand. We have seen investment demand pick up over the last year or so, and I think that the political environment clearly has something to do with that. But I don't know that I would care to try to quantify how much, that's a little bit like using 6 matches to light a bonfire and saying, and then trying to quantify how much how much each match is responsible for. Not a game that I'm good at playing, David.
Are you expecting, well, let's frame it differently. Are you expecting more investors to price in more of a premium going forward? In other words, are you expecting hotspots to erupt such that people would rush to gold for safety?
I don't know about rushing to gold for safety. I think most of what we've seen has really been solid, long-term strategic asset allocation type buying. There may have been some speculative froth in there, but I think that the speculators, they tend to really appreciate the liquidity that ETFs such as GLD can bring to this market. They like the low trading costs that solid liquidity gives them. So if we were seeing speculative demand in the market, I would expect to see it more in exchange traded funds than in the various other forms of gold investment. And we haven't seen a big surge in ETF in buying of gold ETFs at this point. If we do, then I think some of that may well be speculative, but some of it may still be just the continued growth that we've seen over the past 20 years in long-term strategic asset allocation buying.
Right. Historically, let's talk about some macro variables that may impact the price of gold. Um, Two of the most important were highly correlated variables, should I say, with gold, the dollar and the real interest rate. Let's start with real interest rates first. As you know, the 10-year real interest rate has been rising all throughout the last year, and actually since 2021. Are you surprised that gold has continued to rise alongside real interest rates, given that historically they've been negatively correlated?
Yeah, I'm not so sure that the relationship between gold and real interest rates amounts to. I'm not sure that I would call it statistically significant in terms
Okay.
of being a correlation. I think that the correlation that I tend to watch is the relationship between gold and the dollar. And I think that sometimes moves in interest rates can move the dollar. But I think that there's a lot of people who I think mistakenly think that it's interest rates that move the gold price. It's not. It's the response of the dollar to interest rate moves. That's what moves the gold price. If you think about it, we've had, you look at you look at 3 or 4 of the most recent periods when the Fed has been in sustained tightening mode, the gold price has gone up. Along with interest rates going up as well, whether you're looking at nominal rates like the Fed funds or whether you're looking at real rates on the 10-year. So I don't see a strong inverse correlation type relationship there. What I do see is that for most of the time that I've been looking at gold, that there has been a kind of inverse relationship with the US dollar. And again, as I say, the course of the US dollar can often be significantly impacted by changes in interest rates. But if you think about it, in 2022, the Fed was of the opinion that markets were not really taking them seriously. They were already starting to use the mantra of higher for longer, and the markets continued to go up without really paying the Fed very much attention. So I think the Fed decided to get the market's attention, which is why they raised rates. Having raised rates by 25 basis points most meetings, they suddenly decided to raise rates by 75 basis points at 3 consecutive meetings in the fall of 2022. Now, that didn't hurt gold, but what hurt gold was the fact that those interest rate increases drove the dollar to a 20-year high against any other currency around the world that you care to look at. And that, I think, posed something of a headwind for gold. It didn't drive the gold price down. Gold didn't go down in 2022. It didn't go up either. So I think what the strength in the dollar did was pose a headwind, which prevented gold from going any higher. It may be that we've started to reel in the increases that we might have seen a couple of years ago. That may be part of the reason for the strength in the price today.
You're absolutely right about the relationship between the gold price and the dollar. It's interesting, though, ever since I'm looking at a chart here, ever since the end of March or middle of March, the gold price and the DXY have moved in tandem, meaning in a straight line upwards. How do we explain that?
Yeah, as I say, for most of my career, I expected an inverse correlation. It was never a one-to-one, but I expected an inverse correlation between gold and the dollar. When the dollar was strong, I expected gold to be weak and vice versa. But I think 2008 changed an awful lot of things. And one of them is there's been a significant change, a sea change, if you like, in the relationship between gold and the dollar. What we have now is that when the dollar is strong, gold can go up, down, or sideways. It has at various different points since 2008 done all of the above. But every time the dollar has weakened since 2008, then gold has tended to go up. So what you have now is not an inverse correlation. You have an asymmetrical relationship. And I think that that really works to gold's benefit. Because if you think about it, when the dollar is strong and everything in the market seems to be fine and equities are going up, then you don't worry about the protective assets. You don't worry about the performance of your hedge against potential poor performance by equities or by the dollar. But it's when equities and or the dollar tend to go down, that's when you want to be damn certain that your hedge, your protection against that weakness is performing. And that's exactly what gold has done in the 16 years since 2008.
Well, let's talk about equities. We're going to go through all these variables that have been historically important for gold. I'm just from a sentiment perspective, you're right. The perception of gold is a safety play, but there just doesn't seem to be a lot of risk off appetite, at least not until last week. As you know, this year, the Dow Jones has continuously broken new all-time highs. Bitcoin, what maybe many consider a speculative asset, has broken new all-time highs. There seems to be a lot of market euphoria towards risk-on assets. So why still the positive sentiment towards gold, which is nothing at all, like Bitcoin or tech stocks?
It is an odd situation, isn't it, to see equities, cryptos, and gold all hitting record highs very, very close to one another.
And by the way, I don't mean to interrupt. The last time it happened was when the Fed had a limited QE back in
Right.
2020. That's not what's going on today. So I'm curious to get your thoughts.
Yeah. No, look, I think you're right that the market still has a very serious appetite for risk. I might even venture that that might well be something that the markets will find rather dangerous in the coming months. Just an opinion, that's all. But the markets still have a very serious appetite for risk. You're absolutely right. But I think it's in that kind of an environment when most investors are going risk on as much as they possibly can and levering up in order to go risk on. It's at that point that the more cautious people, perhaps the more conservative people, investors such as myself, really see the true value of the protection that gold can offer against potential weakness in other markets. And I think that I like the notion of protection, and I like to add to protection. The more, I may be doing the same thing. I may be adding to more risky assets, but I'm also adding to more protective assets at the same time. And I think that's really just readjusting my portfolio to the market circumstances at any given time, which I try to do. So I think that there are a number of people whose response to the market's insatiable appetite for risk has been to look for a risk-off asset such as gold. And I think that's one of the reasons why gold has done well at a time when the riskier assets have also done well.
A lot of riskier assets have done well. Tech stocks I mentioned, the Magnificent Seven, cryptos have done well. What hasn't done well, at least relative to gold, is gold miners. I'm not saying they haven't gone up, they have, but gold has still outperformed many of the gold miners. And if you look at the GDX over a long-term period, it's still nowhere near its all-time highs of 2011, whereas gold, as you know, has far surpassed its all-time highs. Why this divergence, despite this risk appetite that we talked about, despite the positive sentiment towards gold?
Look, the drivers of gold mining companies' stock price performance are many and varied. The gold price is just one of the inputs. There are all sorts of other inputs into the performance of gold mining company shares. How good is the management? How skillful are they? How good are they? How lucky are they with merger and acquisitions activity? Mining is an inherently risky business. Do they seem to be a company that has mastered the risks, or do they seem to be a company that is exposed to risks? And a whole bunch of different things. All of the things, if you like, that affect the stock price performances of tech or pharma or financials or any other kind of company, because these are companies. They are not just gold. They are gold mining companies, and that means that they have to be properly managed, and all of the things that go with good management. And that's what tends to generate good stock price performance. The gold price is only one element of the inputs that determine the level of gold mining shares.
Well, if someone were to say to you, George, I believe that gold miners are a better way to be exposed to gold than actually the metal itself right now, precisely because of this undervaluation or seemingly undervaluation, how would you respond to that?
I would say that I recognize that when markets are moving up, then the gold mining shares frequently demonstrate some leverage over the actual gold price. I mean, the conventional wisdom used to be a long time ago, but the conventional wisdom used to be if gold goes up 1%, gold mining stocks will go up 5%. I don't know that it was ever that mathematically clear. But nevertheless, I do understand the concept of leverage. The problem is leverage is great when things are moving up, but leverage can bite you when things are going down. And that is always the issue. When gold mining, when the stock market takes a downturn, then typically in history, gold mining company stocks have gone down with the general level of the gold price. They're not protected by their exposure to movements in the gold price. Whereas a pure investment in gold, such as GLD, for example, or in the physical possession of bullion on one's own account, that responds purely and simply to movements in the gold price, and that's really all. So that there is a difference there that gold mining company stocks remember that they're stocks whenever the stock market takes a downturn. And I think part of the reason why people have been buying more gold recently investors have been buying more gold recently has been growing fears of some kind of softening in the equity market. The equity market's gone up very, very powerfully for a very, very long time. And I think it's very easy for people, especially newer investors, to forget that markets are still cyclical. I'm trying not to forget that. That's one of the reasons why I still think of gold as a very, very good bet because of the protection that it offers.
Well, the equities outlook aside, if a gold bear were to make a bear case for you, George, and say that, well, a lot of the variables that we discussed that have traditionally held gold back are broken. In other words, the DXY, for example, surging recently in the last couple of weeks, right? That correlation hasn't held. The inflation expectation, which is also traditionally something that people have looked at. Inflation expectations are going down, not up. In fact, the actual inflation rate has been on a downward trajectory for quite some time. And if you take a look at all these things into account, and the current risk sentiment is still strong, if you take a look at all these things that have historically been negative for gold, well, it's only a matter of time before gold corrects to its true fundamentals, which is to be more in line with these macro variables. How would you respond to that?
Yeah, I certainly wouldn't agree with you on the face of that, David.
Hmm.
Absolutely not. Look,
Okay.
I think that we still don't clearly understand the relationship between gold and interest rates. I think that we are getting a better understanding of the relationship between gold and the dollar, which is that when the dollar goes up, gold does not necessarily go down. It's just whenever the dollar goes down that gold tends to go up. So I think we're getting a much, much clearer understanding of that. So I would dismiss that one as an argument. I think that, if we were to get a sudden outbreak of peace around the world, I think that would be a wonderful thing. It may be that some people might tend to reduce their protective assets in the face of an outbreak of peace. But frankly, I don't see an awful lot of chances for an outbreak of peace, given the various different places and the very different reasons why we have conflict around the world, whether it's armed conflict or whether it's just political conflict and posturing. So to me, I think that there remains a very solid case for gold. I think, what I like about gold is that historically, the promise of gold for investors has always had a dual nature in history. That gold can offer you protection against potential weakness in equities, against potential weakness in the dollar, against potential weaknesses in any other investment asset you care to think about. So gold can offer you some protection. And gold over time, not every year, but over time, gold can help to enhance the returns of a properly balanced portfolio. Anything that offers me protection plus performance is going to get my vote as an asset that I want in my portfolio, David.
Something that a lot of people have asked me personally, which I'll ask you. Obviously, nobody knows, but according to your research and what you understand, can we see $3,000 anytime soon? By soon, I mean in the next 12 months.
We
Would that
recently topped
surprise
out.
you? Would that
We
surprise you?
recently
Yeah.
we recently topped out at a fraction over 2,400,
Hmm.
which was itself up, $300 or $400 from the lows that we reached in February, where we were actually under $2,000 for a while. I think it's a lot to ask for another $6,000 on the price within this calendar year. I would not expect that. But gold has tended to surprise me on many, many occasions, and I wouldn't be surprised to see gold take me by surprise one more time. It's not something that I'm predicting. I think that we've already seen $400 of an increase, a little over $400 of an increase from the lows back in February. I think that that's a pretty darn good performance for gold already. I know that when the market's moving up and seems to be gaining momentum, everybody moves their forecasts around. Well, we put out our forecasts at State Street, we put out our forecasts at the back end of last year. They still hold pretty good. Our base case was for gold to trade between 1,950 and $2,200 an ounce. Our bullish case called for gold to trade between $2,200 and $2,400 an ounce. So we're still pretty much in the top end of of the range that we were looking for. We'll take another look at this around about mid-year, David, and we may well adjust our forecast at that point. But this early in April, I'm not minded to make a great big forecast of where the gold price is going to be. I recognize that the banks have to do that because they want to generate trading opportunities and they want to encourage people to take action. I don't have to do that. So I'm not going to change my position at this point. As I say, we believe that our base case had a 50% probability weighting. Our bullish case, that 2200 to 2400, we gave a 30% probability weighting. So we were pretty confident the gold would stay where it was earlier in this year or would go higher. We're 80% confident of that, and I remain confident that those numbers still make sense.
Okay. I'm not saying this has to happen, but suppose we were to reverse engineer a scenario in which gold goes to $3,000. What would that hypothetical catalyst be?
Well, I've mentioned a couple of things that might get us there if we were to fall into recession, which I'm not convinced that Jerome Powell has discovered the magic of never actually having a recession. Higher interest rates have in the past pushed us into recession on more times than I care to think about. So I think a recession might be a problem, especially as that would logically be accompanied by a significant downturn in the US equity market and by a significant downturn in the value of the dollar internationally. So that would be something that that would help to push gold up there. And on the geopolitical front, I've mentioned the possibility of escalation, both in Ukraine and in the Middle East, and the possibility of political action as opposed to political statements as far as China and Taiwan are concerned. So there's a whole range of things out there that could push prices a good deal higher. But I'm not going to bank on them until they actually become reality, David.
Very good. Thank you very much for your analysis today. George, where can we learn more about you and your work?
ssga.com. You can find materials that the team that I'm part of at State Street, the Gold Strategy team, we put out a large amount of written materials. And I think that that's as good a source as any that you'll get. So thank you very much for your time, David. I appreciate the opportunity.
Well, we appreciate your time and your insights. So make sure to follow George in the link down below. And we'll speak to you again soon. Plenty to talk about in the gold market, I'm sure, in the coming months.
I look forward to that.
Thank you. And thank you for watching. Don't forget to like and subscribe.